Silver investors, everyone is screaming crash and moon at the same time, but the people who actually build the models gave you a much simpler message for this month. Welcome to the 7592 war zone. I'm OG John AG, and in this video we're going to map exactly what that means. Why multiple serious forecasts say March silver will mostly fight between $75 and $92, not trend in a straight line. How a daily close above $84 and then 91 Fars 92 can still unlock $100, $121, even $136, where the real danger starts on the downside, $75, $71, $69, and what breaks if we close below each step, and why retail is panicking at every red candle while the base case from the pros is literally one word: consolidation. This is not financial advice. This is a 30-minute war room briefing, so you stop trading noise and start trading the map. Segment 1, the headline you won't see on TV, base case, sideways. Let's start with the most important sentence almost nobody in retail has read. Binance's March 2026 silver outlook, echoed by several other desks, says, the most likely directional prediction for March, silver prices consolidating in the range of $75 to $92 as the market builds a price base that gives managed money confidence to re-enter. Read that again, not moon to 200, not collapse to 20. Consolidation. A sideways war inside a $17 box, 75 at the floor, 92 at the ceiling. Another post summarizes it the same way. Technical outlooks suggest XAG could hover in a consolidation range around $75, $92 as markets clear out recent volatility and build a base for a potential breakout. So the base case from serious technicians is March is not about direction. March is about positioning, taking silver from emotional hands to strong hands inside a defined range. If you don't understand that, every 3 to 5% daily swing is going to feel like the end of the world. Segment 2, where we are right now inside that box. Now let's drop a pin. Where is price today inside that 75.92 war zone? Latest live reads, COMEX spot silver is around $86 to $87 in many feeds, off roughly 2 to 3% from yesterday after tagging the low 90s. FX's street data has it recently at 86.24, down 2.94% on the day after surging past $90 in early trade, with the move blamed on profit booking and dollar strength. Year to date, silver is still up strongly. Year on year, it's up around 170% plus, with a recent peak a few weeks ago over 100 and a blow-off top at $120 in January. So where does that sit versus the forecast? 75 to 92 box. We are currently in the top half of that range, mid-80s to high 80s. 75 is still well below us. 92 is still close enough that one good risk-off day could tag it again. That's why the March forecast used phrases like hover in a consolidation range, clear out recent volatility, build a base for a potential breakout. From a pro's perspective, today's drop from 90s to mid-80s isn't a narrative change. It's exactly what you expect mid-box, chop, not verdict. Segment 3, the three doors, 75, 84, 92. Inside this war zone, there are three doors that decide what happens next. Door 1, $75, the trap door. From the bottom side, $75 is the critical threshold. If the daily price closes below $75, the cup structure breaks and the price opens the potential for a retest to $71. Below 71, the price is vulnerable towards the 100-day moving average at $69. Door 2, 84 hours, the neckline. A daily close above $84 will confirm the cup and handle neckline. In other words, 84 is not just any level, it's the line where the current bullish pattern either confirms or starts to wobble. Door 3, 91, 92, the breakout. Momentum passed. Use $92, validates a full breakout and opens the opportunity to use $100, an important psychological level likely to be reached by mid-March. So the war zone map looks like this: 75.84, lower battlefield, fear zone; 84.92, upper battlefield, hope zone; below 75, pattern break, downtrend risk towards 71.69; above 92, breakout, uptrend risk to 100, 121, 136. Retail is staring at each candle. Pros are staring at these doors. Segment 4, above the box, 100, 121, 136. Let's climb up from the ceiling. If silver manages to hold inside 75.92, close above 84 repeatedly, and punch through 91.92 with rising open interest, the same forecast lays out the full upside ladder. First target, $100, opens the opportunity to $100, an important psychological level likely to be reached by mid-March. $100 is less about math, more about media. It's the number that drags in late money and headlines. Second target, $121. The continued target at $121, retest all-time high, becomes realistic if the rally continues throughout March, supported by rising open interest indicating new institutional buying. This is where the January spike top sits. Extension target, $136, same note, and use 136 full Fibonacci extension becomes realistic if momentum doesn't fade. That's a proper extension level, not a random hype number. Separate harmonic time cycle analysis matches this structure. First major band 99 to 104, then 115 to 122 hours, then 141 plus in the event of a true blow-off. So, above the war zone, the sky is not blank, it has targets, and they're only activated once 92 is gone. Segment 5, below the box, 75, 71, 69. Now we go down the stairs. If silver fails this war zone, the first line in the sand is $75. If the daily price closes below $75, the cup structure breaks and the price opens the potential for a retest to $71. If it loses a $71, the cup pattern becomes immediately invalid, and the price is vulnerable towards the 100-day moving average at $69. FX Leader's February note backs this sequence. They explicitly framed, will XAG USD hold the $75 support or slide further? With next supports around $71 and $68 to $69 on their chart. So the downside ladder is, hold 75, war zone still intact. Lose 75, 71, lose 71, probably 69. You don't need to fear those numbers, you need to prepare for them. As a trader, they're stop loss and short entry signals. As a stacker, they're potential back up the truck panic zones if the macro thesis stays bullish. Segment 6, what experts are actually expecting in March now. What are broader experts saying, not just technicians? CBS ran a piece on what will happen to gold and silver prices this March. Key silver takeaways. Silver currently sits around $94 per ounce, down from the over $100 price it hit just a few weeks ago. Prices should consolidate below $100 until new fundamentals present themselves, according to James Cordier of optionspreaders.com. Experts generally expect silver to rise, but not significantly, with more pronounced volatility than gold. Chandaria notes that silver tends to amplify gold's direction, outperforming gold on both sides of the move. Windmill expects silver's volatility to be particularly extreme as the year goes on, with margin liquidation, producer forward selling, and institutional short selling responsible for the dives. Translate that into war zone language. Consolidate below 100. Exactly what the 75.92 box describes. More pronounced volatility than gold, while you're seeing multi-percent daily swings inside that box. Silver amplifies gold. If gold has a deeper correction, silver may spike down toward the bottom of the box, 75, faster than you think. Experts are not expecting a calm glide. They're expecting a noisy consolidation with occasional lunges toward the edges. That's exactly what a war zone is. Segment 7, Retail Psychology, why everyone thinks it's crash or moon. Now we talk about you, the crowd. Retail right now is stuck in two mindsets. Recency bias, anchored to $120. Many new buyers saw silver near $120 in January and internalized that as normal. Every tick under 100 feels like discount. Every red candle feels like betrayal. Single candle thinking, a move from 90 to 85 feels like a crash if you're leveraged 10x. But inside a 75 to 92 box, that's literally mid-range volatility, not a structural change. So you get YouTube comments and tweets like, crash is starting, it's going back to 20. Buy now or you'll miss 200. Meanwhile, the professional forecast is boring and calm. Hover in a consolidation range around 75, 90 toes, build a base, sensitive to macro drivers. Retail trades feelings, pros trade ranges and triggers. The goal of this video is to take your brain from the first group into the second. Segment 8, macro drivers inside the war zone. Remember the Binance Post's warning. Markets remain sensitive to macro drivers like interest rates, the US dollar, and investor sentiment. Those three drivers explain most of the noise inside 75 to 92. Interest rates. Higher real yields and delayed rate cut expectations can pressure silver in the short term. Surprise dovish moves or signs of financial stress can launch it off support. US dollar. When DXY strengthens, silver often sells off mechanically because it's priced in dollars. That's exactly what FX's street blamed for today's dip. Profit booking and dollar strength. Sentiment. War headlines, banking scares, and stock market corrections all swing sentiment between fear, pro-silver, and risk-on, pro-equities. Silver, as a thin market, overreacts to both moods. So inside 75.92, you should expect green days on fear spikes, red days on dollar strength, or risk-on hours. No single day deciding the whole month. The war zone is powered by this macro volatility. Segment 9, how a pro navigates the 75.92 war zone. Now, how does someone who does this for a living treat this box? 9.1. They respect the box. They accept 75.92 as the primary battlefield until price proves otherwise. They don't build a plan that only works if silver has to go straight to 150 this month. 9.2. They trade the doors above 92. They shift to breakout tactics. Buy dips, aim for 100, 121, 136 with stops tightened under reclaimed support. Below 75, they shift to breakdown tactics. Short bounces, aim for 71.69. Respect the possibility of a deeper wash. 9.3, they size for volatility. They know 3 down or 6% daily candles are normal in this environment. Their position size is small enough that a 10% swing is survivable, not account killing. 9.4, they separate core and trading books. Core, long-term silver exposure they won't dump over war zone noise. Trading, flexible exposure they adjust based on which door price is testing, 75, 84, or 92. You don't need Wall Street access to copy that logic. You just need the discipline to treat 75.92 as a range, not a prediction error. Segment 10, 3 practical plans you can use. Let's turn this into concrete frameworks. Plan A, you're a trader. Base assumption, range until proven otherwise. Long bias, accumulate near 78.80 with stops under 75, aiming back at 88.92. Short bias, fade near 90.92 with tight stops above 93.94, aiming back toward mid-80s. Switch to trend mode only when. Breakout, daily closes above 92 with rising open interest. Flip fully long, targets 100, 121, 136. Breakdown, daily closes below 75. Flip short, targets 71.69. Plan B, you're a stacker, long-term investor. Treat 75.92 as your shopping aisle. Build a ladder. Add small amounts in the low 80s to mid-80s. Save larger buys for any panic touches into 75 to 78. If and only if 71.69 come with full-blown panic, be ready for your biggest allocations. Your risk is not missing the perfect bottom. Your risk is burning all your dry powder at 92 because you thought 120 had to come back in a straight line. Plan C, you bought high and are stressed you got in near 100, 120. Now you're watching 85, 88. First, accept silver's nature. This swing is part of playing in this arena. Second, decide ahead of time. If we test 75, do you hold, add, or panic sell? If we reclaim 92, do you lighten up or aim for 100 plus? A sensible approach. Reduce leverage and size so 75 is emotionally tolerable. Promise yourself you will not panic sell into the lower half of the box just because Twitter screams crash. Segment 11, why war zone is actually good news. Calling 75.92. A war zone isn't bearish. It's actually a kind of protection. Without a box, every move feels arbitrary. You either over bullish or over bearish with no structure. With a box, you know your risk band. You know where the real danger is, 75, 71, 69. You know where the real opportunity is, above 92 toward 100, 121, 136. It lets you stop asking, is this the top, is this the bottom, and start asking, where am I inside the war zone, and what does my plan say I should do here? That's what separates the guy doom scrolling on his phone from the person quietly executing a strategy. You've been watching John A.G. here, and I'm OG John A.G. If this helped you see March not as random chaos, but as a 75.92 war zone with clearly marked doors at 75, 84, and 92, hit like so this doesn't get buried, smash subscribe with all notifications on, and drop a comment, I'm trading the box, 75 floor, 92 ceiling. Tell me whether you see yourself playing defense near 75, offense above 92, or just accumulating calmly inside the range, because on this channel we don't chase every headline's mood swing. We read the expert's map, mark the war zone, and fight our battles where the levels, not the panic, tell us to.